And for his perspectives on the markets, we're joined by Adam Thurgood, Managing Director with HighTower Advisors. Adam, good to have you on the show here in Set with us.
It's a pleasure to be here, Michelle.
So Adam, the S&P 500 breaking that 2,000 level. Is this just a psychological milestone, or does that to you mean that a resistance level has been breached?
I think it's a bit psychological, but I don't believe that because we've crossed the 2,000 mark that suddenly buying will pick up and the retail investor will come surging back.
But what about institutional investors? How do they view this?
They've been buying all along, so I don't think this will be a big catalyst either. It's just a nice round number that we can all feel good about over a long weekend, but I wouldn't read too much into it.
Well, investors certainly seem to be liking the S&P 500. It's up 8.4% so far this year. Are the fundamentals supporting this? Are we seeing this justified in price to earnings ratios in the second quarter corporate earnings, in the economic data? Or is it just simply a case of the U.S. market is the lesser of all evils and just the best place to park your money right now?
I think it's a bit of both. The S&P is trading at about 18 times its price to earnings multiple, and that's above the historical average. If you look back over the past 60 years, the average is about 16.5. So we're past fair value. But what's interesting is if you look back over 60 years, we've been above this level 33% of the time. So we're not that far away from normal trading environments. And earnings have been strong, the economy is getting better, and I think people are comfortable with what's going on underlying the economy.
When we look at earnings, there was a concern this time last year that revenue was not rising, although companies did beat estimates by cutting costs. That trend has somewhat changed this quarter.
Yeah, we've seen revenues pick up. We saw sales growth in the 4 to 5% range. We're expecting to see another 5% or so top line growth over the next year, and that's great because companies have cut margins or cut costs and improved their margins. When you get a little bit of pickup in sales, it all flows to the bottom line.
All right, Adam, September, notoriously a bad month for the markets. They usually pull back. Given we're at these high levels, do you expect at least a technical pullback this month?
We could see one, and I think you'll know the answer by the end of next week. We have a lot of important data coming out about the manufacturing sector and the services sector, and of course, the first Friday of every month sees the big jobs numbers. So if any of those disappoint, you might see the market start to retreat a bit.
You know what is interesting is that the markets, for the most part, have really dismissed all of these geopolitical factors around the world, from Iraq to Syria to ISIS to Ukraine to the situation in Gaza, even an outbreak of Ebola. Today, we have the UK raising its terror threat level. Again, U.S. markets dismissing this. What's going on?
Well, I think if you look back over what's happened over the past 4 or 5 years, whenever a geopolitical event is flared up, it's receded without any impact to our economy. And at this point, I think traders and market participants, everything that's going on geopolitically will have an impact on our economy. Now, Russia's a wild card.
Not even sanctions, not even Russian sanctions. Surely that's going to have an impact on some companies.
It will certainly have an impact on some companies. You're starting down on the result of that. But I don't think you're going to see widespread issues unless Russia gets more aggressive. And then you really have to start to worry about war, and that's something nobody wants to see.
Well, in the meantime, the NASDAQ, the best performing index year to date, up 9.7%. There are companies in there that could perhaps have some frothy valuations. We had Fed Chair Janet Yellen saying that she thinks social media and perhaps some tech sectors are overvalued. Is this a concern? What do you think?
I think when you look at technology, you have to split it in two. You've got new tech, which is a lot of social media companies, and those are trading at really extreme valuations. And then you've got old tech, some of the hardware manufacturers, the chip makers, and those companies are actually at pretty decent values. So when you look at it bifurcated that way, I think you can make a case for technology in the old school sense, but the new sense freaks me out a little bit.
The new sense freaks you out. What freaks you out to the extent of a social media bubble that we've been talking about for the longest time?
You're seeing really high price earnings ratios in a lot of these companies, and unless earnings materialize at a very high rate, they're at risk of a significant pullback.
Should that pop, could that drag down the whole NASDAQ?
I don't think so, no. They're too small a segment of the entire population of securities.
Of course, the markets, investors all watching the Fed very closely. We didn't get much insight from Janet Yellen in Jackson Hole. We'll see what happens. We may raise rates, we may not raise rates. What's your outlook?
I think they're on pace to raise rates sometime between March and June of next year. I think the economy is going to get stronger from here on out, and it might force their hand a little bit. But when I take a step back and look at what the Fed's objectives really are, they don't want to battle deflation anymore. They'd much rather battle inflation. So I think they'll willingly get behind the curve in order for that to happen.
Very quickly, Adam, what's your projection for the S&P 500 for the next quarter?
3-month projections are always tough, but I'd say a bit higher, maybe 30, 40 points higher.
All right. Great to have you on the show. Thanks for joining us. Adam Thurgood, Managing Director with HighTower Advisors.